Switzerland drops gold and quietly loads up on silver. When headlines like that begin to circulate, the world pays attention. Because when a nation long associated with financial precision, stability, and discretion appears to shift its stance on precious metals, it doesn't just spark curiosity, it raises deeper questions. What changed? What are they seeing? And why now? For decades, Switzerland has carried a reputation as one of the most disciplined stewards of wealth in the global system. Its central banking tradition, its vaults, its history of neutrality, and its role in the international gold trade have all reinforced a powerful image. Gold and Switzerland have often been mentioned in the same breath, almost inseparable, in the public imagination. So when discussions emerge suggesting that Switzerland is reducing its gold exposure while increasing its position in silver, it feels almost symbolic, like watching a long-standing pillar quietly adjust its foundation. But before we jump to conclusions, let's slow down and explore what this could mean. Because in the world of central banking and institutional finance, nothing is ever as simple as it seems on the surface. Gold has long been viewed as the ultimate store of value. It carries history, tradition, and psychological weight. In times of uncertainty, gold often becomes a refuge. Investors turn to it when confidence in currencies or markets wavers. Central banks accumulate it to diversify reserves and signal strength. Silver, on the other hand, plays a dual role. It is both a precious metal and an industrial commodity. It moves with investment sentiment, but it also responds to manufacturing demand, technological development, and global production trends. It's dynamic, it's reactive, it can be more volatile. And in certain economic environments, it can outperform gold in unexpected ways. So why would a nation known for stability consider leaning more heavily toward silver? Some analysts suggest that this could reflect a broader strategic recalibration. Not an abandonment of gold, but a rebalancing. Central banks constantly evaluate their reserves based on currency trends, inflation expectations, geopolitical risks, and global trade flows. Even subtle adjustments can signal evolving priorities. There are also broader macroeconomic currents to consider. The global financial system has been navigating shifting interest rate environments, inflationary pressures, and new technological transitions. Industrial demand for silver has been influenced by renewable energy technologies, electronics manufacturing, and emerging sectors that rely heavily on conductive materials. If a country anticipates sustained demand growth in these sectors, increasing silver exposure could be seen as positioning for structural shifts rather than short-term speculation. And then there's the psychological element. Gold is often defensive. Silver can be both defensive and opportunistic. Moving towards silver may reflect confidence in certain forward-looking industrial trends, while still maintaining exposure to tangible assets outside purely fiat systems. But the story doesn't end with Switzerland. The mention of J.P. Morgan Chase adds another layer of intrigue. As one of the largest financial institutions in the world, its views on commodities, metals, and macroeconomic risks carry significant weight. When analysts at major banks issue warnings or highlight emerging risks, markets listen. According to available information from various financial commentary sources, some analysts connected to large institutions have issued cautionary perspectives about market volatility, currency fluctuations, and structural imbalances. These warnings are often measured and technical, not dramatic. They speak of liquidity cycles, debt levels, and asset repricing. When you combine a possible shift in Switzerland's precious metal allocation with broader cautionary tones from global banking institutions, it creates a narrative of quiet preparation. Not panic, not alarm. Preparation. There's a difference. Central banks rarely act impulsively. Their decisions unfold through committees, research, and long-term frameworks. If adjustments are being made, they are likely the result of careful analysis rather than emotional reaction. But here's where the story becomes even more interesting. Silver historically tends to move more aggressively than gold during certain economic phases. When confidence rises and industrial activity expands, silver can accelerate. When fear increases, it can sometimes fall harder before rebounding. Its personality is more complex. So what environment favors silver accumulation? One possibility is an anticipated wave of infrastructure transformation. Green energy technologies, solar applications, electrification projects, and advanced electronics all require silver in meaningful quantities. If policymakers expect sustained industrial expansion in these areas, positioning reserves to benefit indirectly from that demand might make strategic sense. Another angle relates to valuation ratios. At times in history, the relative price relationship between gold and silver has shifted significantly. When that ratio stretches beyond historical norms, some investors interpret it as a signal of potential reversion. That doesn't guarantee outcomes, but it influences strategy discussions. Now let's pause for a moment. If Switzerland is indeed adjusting its metal strategy, and if major financial institutions are issuing measured warnings about economic turbulence, what does that tell us about the broader environment? It suggests complexity. We are living in a period defined by transition. Currency systems are evolving. Digital assets are emerging. Supply chains are being restructured. Geopolitical relationships are shifting. Inflation debates continue. Growth patterns are uneven across regions. In such an environment, diversification becomes more than a buzzword. It becomes a necessity. And this brings us to a deeper layer of interpretation. Gold has always represented stability. Silver represents both stability and participation in growth. A move toward silver could symbolize an attempt to bridge defensive positioning with participation in industrial transformation. But what about the warnings? When institutions like JP Morgan Chase publish research pointing to potential financial stress, they are not predicting collapse. They are outlining scenarios. Banks constantly assess risk factors such as debt sustainability, interest rate sensitivity, currency imbalances, and asset valuations. Some reports suggest that elevated global debt levels combined with changing monetary policies could lead to increased volatility in certain asset classes. Volatility does not equal crisis. It simply means movement, sometimes sharp movement. In volatile periods, traditional correlations can shift. Assets that once moved in tandem may diverge. Safe havens may behave differently. Liquidity can become more selective. And that's where precious metals often re-enter the conversation. Here's the secondary hook. What if this isn't just about metals at all? What if it's about positioning ahead of structural change? Consider how central banks think. Their time horizon spans decades. They are less concerned with quarterly earnings and more focused on preserving purchasing power, maintaining stability, and hedging systemic risk. If economic leadership anticipates a prolonged era of fiscal adjustment, technological transformation, and shifting trade dynamics, reserve composition becomes a subtle but powerful tool. Switzerland's financial system has long been associated with prudence. Any perceived shift in its strategy invites global analysis, not because of drama, but because of its reputation for caution. Now let's look at silver from another perspective. Silver's industrial demand ties it to the real economy in a way that gold often is not. Gold demand is driven heavily by investment, jewelry, and central bank purchases. Silver demand blends investment and industrial consumption. That means silver can reflect confidence in manufacturing and technological development. If policymakers believe that industrial activity will remain resilient or even accelerate despite broader financial uncertainty, increasing silver exposure may align with that outlook. At the same time, silver retains monetary characteristics. It has been used as money throughout history. It carries intrinsic value. It is globally recognized. In periods of currency debate, silver remains part of the conversation. Now let's address the psychological dimension. Markets often move not only on data, but on perception. When influential institutions issue warnings, even cautious ones, investor behavior can shift. Risk tolerance adjusts. Portfolio allocations evolve. If Switzerland appears to be recalibrating while major banks caution about potential turbulence, observers may interpret that as a signal of strategic caution. But signals can be misread. Public speculation sometimes amplifies small adjustments into dramatic narratives. That's why it's important to rely on verified information and avoid jumping to conclusions. Central bank reporting can be complex. Reserve shifts may reflect routine rebalancing rather than dramatic repositioning. Institutional warnings may highlight manageable risks rather than imminent threats. The key is nuance. Still, the convergence of these themes captures attention for a reason. We are in a time when traditional financial assumptions are being tested. Inflation dynamics that seemed dormant have reemerged. Interest rate cycles have shifted direction. Currency valuations fluctuate against geopolitical backdrops. In such an environment, precious metals naturally regain prominence. Let's imagine the broader strategic landscape. If global growth slows unevenly, if certain sectors expand while others contract, if energy transitions accelerate, and if currency competition intensifies, then asset allocation strategies will evolve accordingly. Silver sits at the crossroads of many of these themes. Renewable energy systems rely on conductive materials. Electric infrastructure requires components containing silver. Advanced electronics, medical technologies, and industrial applications continue to integrate it. If policymakers anticipate structural demand in these areas, it could justify increased exposure. At the same time, gold remains a core anchor for many central banks. There is no evidence to suggest its relevance is fading. Instead, this may be about balance rather than replacement. Balance between defense and participation. Balance between tradition and transition. Balance between stability and opportunity. Now consider JP Morgan Chase again. Large financial institutions constantly evaluate commodity markets. They analyze supply constraints, mining output, demand forecasts, and investment flows. Some commentary has pointed to tightening supply conditions in certain metals markets. Others have noted that investment flows can amplify price movements when demand surges. If volatility increases in equity or bond markets, capital sometimes rotates into tangible assets. This doesn't always happen immediately, but it has occurred in various cycles throughout history. So when you connect these threads, a picture begins to emerge. Not of panic, but of strategic positioning in a world that feels less predictable than it once did. And unpredictability changes behavior. It encourages diversification. It rewards foresight. It penalizes complacency. As we approach the final stretch of this discussion, let's reflect on the deeper implication. Switzerland adjusting metals exposure, global banks issuing cautious outlooks, industrial demand reshaping commodity narratives. All of this suggests we are in a transitional era. Transitions are rarely comfortable. They create uncertainty, but they also create opportunity. The final hook is this. What if the real story isn't about gold versus silver at all? What if it's about understanding that the financial world is evolving, and those who pay attention to subtle shifts are better prepared for what comes next? Markets move in cycles. Confidence rises and falls. Assets rotate in and out of favor. Institutions adapt quietly long before headlines catch up. The question isn't whether gold is finished or silver is dominant. The question is how global decision makers are interpreting risk, growth, and resilience in a rapidly changing landscape. And perhaps more importantly, how should individual observers interpret these signals? Stay curious, stay analytical, avoid extremes. Recognize that financial systems are complex ecosystems, not simple binaries. Switzerland's reputation for prudence suggests that any move it makes is carefully considered. J.P. Morgan Chase's warnings reflect structured risk assessment, not sensationalism. Together, they remind us that vigilance matters. If you found this exploration insightful, take a moment to share your perspective. Do you believe silver's industrial future strengthens its long-term outlook? Do you see gold remaining the ultimate anchor? Or do you think both will play complementary roles in the years ahead? Let your voice be part of the conversation in the comments below. And if you value thoughtful analysis that cuts through noise and explores the deeper layers behind financial headlines, make sure to like this video and subscribe to the channel. It helps us continue bringing you balanced, in-depth discussions on the forces shaping our world. The story of gold and silver is still unfolding, and as always, the most important signals are often the quietest ones.